I'm Nigel Walker. I'm from the Technology Strategy Board. So we're there to stimulate business-led innovation in order to drive economic growth. We're a public sector entity, and actually one word that hasn't been said much today, but it was sort of cropping up just now, was risk. We're there to take risk on behalf of the UK by using taxpayer money to try to accelerate things that might not otherwise happen in order to drive economic growth. And the main way we do that is by providing funding for research and development projects, typically collaborative, but not always, very often around specific thematic areas, specific challenges that we have identified in conjunction with industry. So the Internet of Things, for example, represents one of those particular challenges within the digital theme area, and I believe a competition has just closed in that area. And my colleague Maurizio, who is here but might just have stepped out because he probably couldn't bear to hear how I'm mangling what we do, is the specific expert there. I'm a generalist in Technology Strategy Board. I'm not a technologist. I don't know anything about technology at all, but I quite like businesses and I know a little bit about money. So my role is around access to finance. My role is actually nothing to do with grants, and what we normally do is about trying to signpost the businesses that we support towards other forms of finance, particularly follow-on finance, so that commercialization can happen. Because we don't just want nice shiny new bits of kit. We want economic growth, and that comes from businesses, that comes from commercialization, from exploitation of that technology. Taking risk, we don't just throw money out, we don't just find something that's nice and shiny and clever. We try to do that strategically, just as an equity investor will look to understand strategically what they're doing, why they're doing it. Is there a market? Is there a good management team? We look at things from a program point of view in terms of, can the UK do this particular thing? Is there excellence in the UK? And that may well be in the science base, it might be in the business community, but we want to focus on things where the UK is really good at doing something. We want to make sure that there's a large market opportunity, and that obviously ties in with what you've heard already from the other investors who've been talking. We don't just want to play in niches, we want to see where there's going to be a significant opportunity for UK-based businesses, because we're putting in UK-based taxpayers' money, we want to see that return to the UK taxpayer. We want to be sure that the idea is ready, and ready for us will mean something different from ready from the point of view of an equity investor, for example. However large the risk appetite of an angel might be, we should have a larger risk appetite. We should be looking further ahead because we're trying to stimulate. And if something is so ready that an angel investor or a venture capitalist will put their money in, or if a bank will lend against it, there's no point putting in public money. So we want to look at riskier things. And that's where the can we make a difference comes in. Can our involvement accelerate something in a way that wouldn't happen otherwise? Our programs cover all sorts of industries across the economy. Things at the top here around energy, healthcare, etc. Are very much around societal and economic challenges. At the bottom here we have some of the underpinning technologies, and in the middle we have things like high-value manufacturing and digital services that are core competencies that any economy needs in order to take some of these underlying technologies and develop them and use them in those societal and economic areas. And this is sort of what you're probably most interested in. What are our tools? How do we make money available? A wide range of tools. Collaborative research and development competitions are where most of our money is used. So things like the Internet of Things convergence competition that recently closed is an example of that. Things like entrepreneur missions. That's very much about trying to take entrepreneurs with other entrepreneurs on a selective basis to somewhere. For example, we recently ran a future health mission. We took healthcare entrepreneurs to Boston, where there was a significant healthcare conference going on. We gave them an opportunity to meet customers, to meet regulators, to meet investors, to meet other entrepreneurs, so that they could become better businesses and maybe even find some money. Some of our interventions happen at the level of an entire sector. For example, catapult centres. Those are large technology and innovation centres that will have a physical presence, and we have those in areas such as future cities and the connected digital economy that I think are both very, very relevant for the Internet of Things. Entrepreneurs and the academics in this group, those technology and innovation centres, those catapult centres, should be working with universities, with businesses, trying to stimulate innovation in that way. Other things work at more of a sectoral programme level, such as our collaborative R&D programmes. Some work at an individual company level. So SMART, for example, which used to be called Grant for Research and Development, and before that it was called SMART, and now it's called SMART again. We don't set the challenge there. We don't define the scope, the timing, the size of those competitions. Well, actually, no, we do define the size. The scale of those competitions, those are open all the time for any business to apply to us, and they cover things like proof of market, proof of concept, development of prototype. All our programs are competitive, and we don't have a 3% success rate. It's more like, for something like SMART, it's around 20% at the moment. So we have a finite amount of resource that comes from the government. We want to pick the best quality opportunities. So we use independent assessors to evaluate all the applications that we receive. They look at things from a technical point of view. They look at things also from a commercial point of view. They look to see whether they fit within those criteria of, can we make a difference? Is there a significant market opportunity? Is there great idea and technology there? It's not peer review. I often hear people talk about our assessment process as peer review. It's not peer review. It's not due diligence. It's an assessment on a technical and a commercial basis to see whether whether applications are the right quality, and on a competitive basis, who should win funding from us. We provide grants. So we, apart from SBRI, which is actually a contract between a government department and an innovative supplier to that government department, all our other programs pretty much are about grants. So we will provide a proportion of the costs of a technology project or of a research and development project, and the amount of grant that we are able to provide depends upon what sort of R&D is being carried out, whether it's industrial research or experimental development and things that I don't really understand. So the range varies, but it's about 50% on average. Smart Awards, I just mentioned. These are our most popular program because they're open to anybody to apply to, very popular. Go to our website at innovateuk.org and take a look at that if you think that may be of interest to you. The other thing that we try to do is to connect the innovation landscape. We want to accelerate innovation, and bringing people together is a very important part of that. Some of that happens through collaborative research and development competitions. A very big part of it happens through our knowledge transfer networks. So the Creative Industries Knowledge Transfer Network and ESP and ICT come together to create this Internet of Things special interest group, and we have a platform for open innovation that we call Connect, with a trendy underscore, which sort of makes it social media oriented. Or maybe not, enough for a non-technologist like me to get, that has a fantastic, amazing array of information on, and I would thoroughly recommend, if you're an innovator, to join that platform and engage. And there's even an investment network where there's some, I hope, helpful advice for entrepreneurs who are seeking funding. And I need to update on crowdfunding a bit to talk about underlying infrastructure platforms, which is currently missing, but hopefully that's useful to you. Uday asked me to speak briefly then about stuff outside of TSB, sort of my access to finance area. And I just wanted to mention a couple of things that this government is doing, and I think any sensible government would do, in order to promote access to early stage finance. One significant thing, I think, is the angel co-investment fund. We've heard about how business angels invest in particular size blocks, maybe sort of £100,000 up to £250,000. When they need to follow on, that can become tricky. The answer to that is that angels are often trying, therefore, to bulk up. They come together in syndicates, and the angel co-investment fund is a way for the government effectively to put public money to co-invest alongside angel syndicates in order to bulk up their investment capability and capacity. The enterprise investment scheme has been mentioned by Peter already. I'd also mention the seed enterprise investment scheme, which is a fantastic tax break. That's up to 50% tax relief against an investor's tax. It's up to £150,000 per qualifying company in any 1 year, £100,000 of investment. It's not just for high net worth individuals, it's for lots of people. Probably any of us here that wants to accept the risk and hope to have a better return than you would get in a bank account. And that even has a capital gains tax holiday this year as a special one-off present from the government. And there are other things like mentoring and coaching schemes, because I firmly believe that businesses want money often, particularly at an early stage. They need more. You've heard talk about the importance of teams, the importance of business capability. Growth Accelerator is a programme funded by government, £200 million being put into that programme over 3 years. It's aimed at trying to provide business coaching to 26,000 high-growth, small and medium-sized enterprises in England in a 3-year period, focusing on help to innovate, access to finance, leadership and management, and help to commercialise. So I think it's a very important programme that I would encourage you all to look into. How am I doing for time?
You're okay.
Okay. I really liked your slide just now where you had a wiggly line, because I don't believe in this model. This is from Nesta, who I have a huge amount of respect for. They have a really, really good research team, and I think that this is an oversimplified model. We talk about the finance escalator, and people think of a beautiful escalator. This is Canary Wharf, one of my 2 favourite tube stations. Because it's beautiful. You can imagine this escalator going beautifully up, and it's shiny at the top, and it's fantastic. My other favourite tube station is Westminster, and I think this is more what it's like. It's muddled, it's confusing, there are steps, there are escalators, it's concrete. So what is happening in the venture capital market? Data's not very easy to come by, but Nesta, as I said, I have a lot of respect for them. They did a fantastic report, slightly dated now, sadly, but I would recommend that anybody should read it to get a sense of some of the data around what's happening in venture capital investment at the moment. And these are basically some trends for you. Investment is down, both by number and value of deals. The usual suspects get all the attention. So low capital requirement, so that probably means they're in the digital space or something related to the digital space rather than advanced manufacturing. And they're probably based in London and the southeast. So if you're a manufacturing company in Runcorn, perhaps not getting the VC attention that you're looking for. Exits are down. There was a peak in 2006. Funds aren't really realising their exits at the moment, and that time to exit is increasing. So Nesta's average that they tracked was 5.7 years. That ties in, I think, with the 7 years that you heard about earlier on. And a lot goes in before anything comes out. So on average, Nesta measured around 4 rounds for each investment before an exit was made. And those 10 times exit multiples, they're rare. In Nesta's study, I think they showed in 2010 in the UK there were 2. And there's very little new money going into venture capital at the moment. So venture capitalists, who are specialist investors, are focusing on their portfolios rather than on spending new money, making new investments. And that's driven by the lack of exits. This is some more recent data. This is from UK funders who try to track exactly what's going on in the market. they're showing actually a much larger number of deals. This is not just venture capital, this is early stage venture capital and probably includes some angel transactions as well. And I think also includes some crowdfunding transactions, and one of the reasons they give for why the number of deals has grown in 2011 and particularly 2012 is because of the advent of crowdfunding, particularly from an equity point of view. The other interesting thing that is worth looking at here is this little green line here, which is the 500 to a million amount of investment, and from, I think you were saying earlier, that's the tricky bit. That chart appears to show that. There's even less data available about what's happening in the angel market, mainly because it's quite private. But Colin Mason and Richard Harrison did a study for Biz recently, and came up, well, it's not that recent, but they came up with some data around what's happening in the visible angel market, i.e. deals that are reported to angel networks or that involved angel networks. And typically they're playing under the radar screen, as you would expect. And the sort of size where they typically work is around the sort of 100 to 500,000 pound investment, and it's increasing. And backing up what I was saying earlier about the angel co-investment fund, when the amounts start to get larger, it's not single angels, it's syndicates of angels, and we're seeing more formalization of those syndicates now, perhaps driven in part by the angel co-fund. But 3% is an interesting number, isn't it? Because Springboard mentioned it. This shows, you probably can't see it, but in 2009-2010, these academics counted that almost 10,000 business plans were received by the angels that they surveyed, of which 238 actually received funding, so 2.5%. Of the 10,000, about 700 and 800, so about 8% actually got to present. So as an entrepreneur, you shouldn't be relying upon this sort of finance as a slam dunk. It's hard. And it's specialist. It's not suitable for everybody. And not everybody is suitable for this market. And one final slide, I think it is, yes, is lending. Probably doesn't happen a great deal for early stage entrepreneurs in the Internet of Things market. But just so you know, actually, I've got a picture of the 2012 Bank of England report. Actually, these data are a bit more recent. But the rate of growth of lending from banks to SMEs, it's gone down, but it's levelling off. The cost of borrowing is remaining fairly flat. But the interesting, I think, is that whilst the availability of credit is flat and the cost of credit is flat, where the banks are lending, they're finding actually that demand from SMEs is the thing that's down at the moment. So whether it's price, whether it's the terms and conditions, whether it's hoarding cash, whether it's small businesses or medium-sized businesses, and this probably excludes startups, obviously, the demand is down. So this whole question of are banks lending or not lending, is the funding for lending scheme that's supposed to make all our lives so much easier, is that actually working? At the moment it seems as though it's not quite kicking in yet. So there was a very quick whiz through the market, and that's our website.